of Producer Services here for Insurance Agency Marketing. Just wanted to say thank you so much for attending our webinar. We so greatly appreciate it. We have, close to 300 people attending the webinar, so whatever questions you may have, please get them in as quickly as you can. We will try to answer any and all of your questions. Any questions that we are not able to answer, we will make sure to personally call you or email you and get those questions answered. Again, Insurance Agency Marketing Services does welcome you to this great webinar with Security Mutual. A couple things before we hand it over to Security Mutual for private financing. We have such a great little mini trip to offer any of our agents. It's called Caddies and Casinos, and what it is any producer who writes and places $1,250,000 in Athene annuity qualifies for a trip November 1st, 2015 through December 31st, 2016 is a qualification period, so long qualification. Double credits for the month of December, so you can write, $625,000 and place that with Athene, and you can actually qualify for that trip. If you'd like to bring a guest, that amount is $1,750,000, and again, double credits for that. So easy trip, long qualification for you to attend. We also have a lot of great services here at Insurance Agency Marketing for any of our contracted agents. We offer any logo, branding, stationery, letterhead. We can help design cards for you. We do basic online marketing. So if you don't have a website right now or a newsletter service, we will help you get up and design a website and also manage that website. We help with radio ads and television ads, and again, any type of website or newsletter service, we are more than happy to assist with. We have a great design team, and they do an amazing job, and again, would discuss it with you and find out what would fit best for you. We also have, for any agents who are contracted with us, in their first 6 months, if you're a newly contracted agent, you have such a great opportunity to earn not only your commission, but great bonuses. You are able to earn, if you place $100,000 with us in your first 6 months, and that's life, annuity, MedSup, or long-term care, you receive a $750 cash bonus. If you choose not to get the bonus, you can get a 2-year subscription to a website and newsletter service. You place $300,000 with us in your first 6 months, and again, that's life, annuity, long-term care, and MedSup. You have an option of getting a $1,500 gift card or a full Social Security program with a 3,000-piece mailer. If you place $500,000 with us in your first 6 months, you receive a Ritz-Carlton travel rewards. It's a make your own personal getaway. If you don't choose that, you can do a 5,000-piece mailing and seminar coaching with Matt Gill. We also offer, it's industry recognized, our IAMS Life and Annuity Academy. It's a 2-day training where we go over any new information in the industry, any laws that are changing, anything that will affect you as the agent or you and your clients. We go over indexed annuities, income riders, current annuity trends. We do a client risk and needs analysis. We break up with our top producers into mini groups and go over client objections and what has worked best to overcome those objections. We go over our software support. We have a great annuity alternative in single premium life. We go over that as well, along with wealth transfer. Again, industry recognized. Our next one will be February. Those go quick. We typically have, 300 to 400 people who want to register for that, and we take 40. So if you're interested, let us know soon. We'll get your name up there and see if it's a great fit for you. In addition to our great trip that we're having with the casino and caddies with the theme business, we are also having an IMES great trip at the Fairmont Empress. It's for our Top Producers Escape. That will be held August 3rd through the 7th of 2016 in Victoria, British Columbia. It is a beautiful trip. In order to qualify, you would need $2 million in annuity premium that's placed, or $1.5 million in single premium life, $175,000 in life target premium, or you can do $400,000 in long-term care premium. It is a long qualification period, January 1st, 2015 through June 30th, 2016 will get you and a guest to that Top Producers Escape. I would love to see you there. Please let me know if you have questions on that or any of the qualifications. When you are writing your annuity business for that great trip of casino and caddies, all of that does still qualify you for this trip as well. So that piece of business qualifies you for 2 trips. At this point, I will hand it over to Marty Smith. He is the Regional Vice President of Security Mutual. He will be going over the private financing with their great carrier and how their products are just top in the industry in regards to private financing. So Marty, if you'd like to take over, please.
Thank you very much, Sandy. Hi, everybody, this morning. Hope you all had a great Thanksgiving. I'm Marty Smith. I work out of our New York City regional office. So if you give me a call, you'll know that's where I'm at, looking out down at the Statue of Liberty here. So for those of you who might not be familiar with Security Mutual Life Insurance Company of New York, let me just give you some facts that you should know about us. First, we just celebrated our 129th anniversary. Next year, we will have paid dividends for the last 124 consecutive years. We're either the biggest small company or the smallest mid-sized company that you'll run into. We have $2.6 billion in assets with $31 billion of life insurance in force. We work out of the same building in Binghamton, New York for over 111 years. And based on the experience there, some people are still there from that time. We're still a mutual company. We're owned by our policyholders and we're beholden to no one. We're also conservatively managed. We had no credit default swaps during the Great Recession, and we had no commercial loan defaults in over 10 years there. We only sell through independent agents like you. Our products are geared towards the advanced markets. At Security Mutual Life, we love concepts like infinite banking, bank on yourself, circle of wealth, and college planning. We're a relationship company. We know our agents by their first name. If you have an underwriting question, pick up the phone and call the underwriter. You want to brainstorm a case? Pick up the phone and brainstorm with our advanced marketing team. You have a complaint? Hey, we're the kind of company you can pick up the phone and speak directly to the president, but please don't say I told him that you're calling. Finally, we want you to make more money, and we believe we can show you how. And today we're going to deal with one of my favorite concepts of all, private banking or private financing. Security Mutual has had a very solid relationship with Nelson Nash of Bank on Yourself, with Pamela Yellen, become your own banker for Nelson Nash, with Pamela Yellen for Bank on Yourself, and of course, Don Blanton, Circle of Wealth. So those are concepts that we greatly support and advise on. So let me get started here. The first thing I want to really point out is life insurance is first and foremost a death benefit, and you should never forget that, especially in this day and age where all the regulators want to talk about life insurance as something other than a death benefit. No, it is first and foremost a death benefit. Next, the great thing about being a death benefit is if you don't die, life insurance turns out to be a deferred asset. And we're going to show you this morning just exactly how that would work here at Security Mutual. And then finally, At Security Mutual Life, we like to say that life insurance is also a current asset and should be used on a current basis there. So those are the three main concepts. I'm going to go through how they work at Security Mutual. So let me start with a story. I have a 30-year-old son, and I would have a conversation with him, and I said, son, do you believe that Social Security will be around 40 years from now? And of course, his answer is, no, I don't believe it will be. Then I ask him, do you believe that taxes are going to go up in the future? After all, we have a $18 trillion debt. How do you think that's going to work? Do you think they're going to go up or down, right? So he says, no, I believe taxes are going up. And finally, I said, son, do you believe that you have to invest for your retirement? Like you were being told that your job and all your friends are being told that, you know, you need to put the money away right now into a 401k or a 403b. And, hey, not touch it for the next 40 years. What a great innovation here. There's some genius marketing concepts there. That's not one of them. So I say, son, right now, you and your wife can put away $1,000 a month. If you don't believe Social Security, if you don't believe Social Security is going to be around, that means you're going to have to take care of your retirement for yourself. We're going to show you how to do it. You can put away $1,000 a month. Because you can do that, we're going to set you up with a life insurance policy, a permanent life insurance policy, a whole life insurance policy. For you on the phone, I'm just going to state what it is. It's our LP 121. Notice that my son is a standard. He's not the best of shape, whatever, but it doesn't really matter when you come down to private financing. You want to have that policy there. So what we're going to do is we're going to start you off with a $500,000 death benefit. The annual premium for that is $4,310. There's a $75 policy fee. And then what we're going to do to make up the rest of the $12,000, we're going to put it in our enhanced paid up additions rider. So we're going to put $7,615 into that rider to total to the $12,000. The total death benefit is $540,000. Well, what's good about that? Well, what's good about that is you've protected your wife, you've protected your son, and you've protected the family there. Obviously, you probably need a little more life insurance, and we're going to take care of that down the road. But we're doing this, we're setting this up because we're going to take over for Social Security. You don't think it's going to happen? We're going to set something up for your own retirement that's going to work. So, just to show you over here, the guarantees and non-guarantees. We're going to do something that most people, including most life insurance agents, don't understand about life insurance. If you take a look at this policy, there's two columns. There's the guaranteed side and the non-guaranteed. If you just take a look at those little red marks that I put down there, after 12 years of putting in money, what is your total surrender value on a guaranteed basis? Well, it's $120,000 on a guaranteed basis. If you take a look on the other side of the ledger there for the non-guaranteed, you're at $128,000. So you're ahead of the game. But take a look at this. Your death benefit has also gone from $540,000 to $882,000. Now, what we're doing by setting the policy up like this is we're putting you in control, and we do that because of the way that we've designed the policy. So now, if you're responsible for your own retirement, if you're responsible for your own retirement, we've designed this so that you can put in as much as you can, as fast as you can, for as long as you can. I know a lot of people say that, hey, you want to be finished paying up your life insurance policy. Why would you ever want to do that? You want to use your policy, as was Nelson Nash would say, or Pamela Yellen, or Don Blanton. This has become your own bank. This has become your own private reserve. So if you take a look at this, you've paid premiums for the last 40 years. You're 70 years old. What is your cash value in year 40? Well, if you take a look down there under the red mark, it's $1,245,000 there. So son, I want you to think about this. How much did we pay in premiums? Well, we paid approximately $12,000 for 40 years. So we put in a little less than $480,000. What's your cash value in year 40? $1,245,000. That's phenomenal. So now, since you're still alive, let's take a look at this. As what we said, life insurance is first and foremost the death benefit, but it's also a deferred asset. But let me go back just 1 second so you can take a look. Can anybody see what the total death benefit is in year 40 at age 70? If you can, it's $2,086,000. We started with a $540,000 death benefit. Now it's up to $2 million after 7 years. Who said that life insurance isn't a hedge against inflation? That's exactly what we've set up here. We've got this death benefit, so it's growing, so to keep you ahead of the game. Now, if I can advance the screen 1 second here.
I can help you do that if you need me to. There you go.
Let's advance it one more time. All right, here we go. So son, we said that life insurance is a deferred asset. Let's start taking a retirement income. In year 40, you have $1.2 million in cash value. So what we're going to do is we're going to start taking $60,000 a year for the next 30 years. I have a little question down there. What are the 3 types of distributions, how you take money out of a life insurance policy? For those of you who are adept at that, the first thing and what we're doing right here is we're surrendering our cost basis, and then we're going to take loans. That's one way to do it. The second way is to take loans only. If you do that, the death benefit will stay higher for a longer period of time. The third way is to put the policy on what's called reduced paid up, and then take your distributions. Anytime you're going to do this for your client, what you want to do is take a look to see which is going to offer what the client desires, whether they want to keep the benefit longer or whether they want to maximize their retirement income. So now, as I take you to the next slide over here, what I'm showing here is the continuation of taking that $60,000 a year for 30 years. So think about this. You paid in $12,000 for 40 years or $480,000. Now you're going to take $1.8 million to your age 100. You probably could take it longer, but I just stopped here so you can see what it looks like, right? My question to you, son, is who says that you have to invest for your retirement? We always used to say you save for retirement. You save to send your kids for college. You save because there's a guaranteed way to do that, or there's a safer way to do that. You don't have to put all your money at risk here. So this is what I want you to think about. You put in $1,000 a month, but now you can take $5,000 a month for the next 30 years. Is that a good deal? Does that make sense to you? Can you actually save for retirement? Absolutely. There's no way that you have to invest for it. You can save for retirement. And then let me ask you this final question. How much are you going to pay in taxes on that $1.8 million? As Nelson Nash would say down in Alabama, he'd say you pay nothing, right? Because life insurance is one of the best financial products ever created and has tremendous tax advantages if you know how to operate with it there. So think about it, son. Right now, a loaf of bread costs $1 a day. 40 years from now, it could cost $5 a day, the way things are going. But guess what? You're going to have the money in your pocket, accessing it tax-free in order for you to pay for it. Sounds like a good idea. But now, let me ask this. Son, I guess I'm a little too fast on the draw, Sandy, here. So,
Oh,
but I'm good. I'm good.
how about
This is
that?
where I should be.
All right.
That sounds great. That sounds great here. Now, the reason we showed you how life insurance was a death benefit. We showed you how life insurance was a deferred asset. So now, what I really want to focus on is how life insurance is also a current asset. Frankly, in some terminology, we say that your life insurance policy is kind of like your own bank, whatever. Don Blanton would say, hey, you could use this as your own private reserve. So, son, Mom and I believe that we believe so much in this concept here that we're going to give you and your family a brand new car. But we want you to promise that you're going to pay that premium every year, that $12,000 for as long as you can, hopefully to age 70 here, right? Now, what I want you to do is, if you take a look at year 5, you put in $60,000. What's your net cash surrender value in year 5? If you take a look under that red mark, it says that it's $51,000. 5 years from now, that car is going to wear down. I want you to take it down to the dealership and trade it in for the best car you can get. But before you do that, I want you to call the life insurance company, tell them that you're going to take a $25,000 loan to pay for it, right? That's why we're setting up this policy. We're going to finance it right out of your life insurance policy here. So what I want you to do is have them send you that check or email that or put that money in your bank account there. Go down to the dealership with your car, trade it, and get the best, safest car you can. All right? But I want you to do something this time around. I don't want you to pay it back. And frankly, I want you to do this every 5 years when the car wears out, whatever, go down to the dealership, trade it in, and get the best buy that you can. You're going to do this now. You're going to do this now every 5 years for the next 35 years, but you're not going to pay back the loan. So if you're going to take a look at that, whatever, what I want you to see is that, you know, what's your cash value going to be in year 40 if you don't pay back the loan? Well, it's $767,355. And what's your total loan? Well, the total loan would be $477,729. So here we are. How much did you pay in premiums during that time? Well, I actually added them up to give you a better look at that. It's $466,454 minus your total loans is $175,000. So what was the total that you paid in, subtracting the loans there? It's $289,054. All right, now why did I do this? Well, because I want to ask you to take a look again. What is your cash value in year 40? How much did the cars cost you? Now, when I ask agents on the East Coast or West Coast, how much did the cars cost you? They would always say to me, oh, well, you put in $289,000 and you have $767. The cars cost you nothing. So I said, well, no, that's not exactly true. When I then ask agents from the Midwest or from the South and say, well, how much did the cars cost you? They would say, oh, well, the cars cost, you took $725,000 loans. It cost you $175,000. I said, well, you know, that's partially true there, but there is another number on this page that represents the true cost of those cars actually cost you. And that number is under the total loan column, because in effect, what those cars cost you, if you took $725,000 loans at 5% on the schedule on the schedule that we took them for the past 35 years, whatever, you'd find out that that number would add up to $477,000. You know, another name for that might be opportunity cost. So, son, what I want you to do is think about this. Is that $477,000 a real number, or is it some phony hypothetical life insurance illustration number that the companies have to put in? So the answer really is, I want to assure you that it's a real number, because that's exactly what that loan amount would be if you didn't pay it back. But there's something else I want to show you that is really cool. And if it just moves one little thing, I'll be good.
How's it going, Marty?
It's I'm having a little distress here. If you could just put it back one more. That's all right. Now I have to advance it one more. Okay. I'll advance it one more. Sorry about this, folks. This is what's cool. What I want you to do is I want you to add up the cash value in year 40, which is $767,000. And I want you to add that to the total loan value in year 40. That's $477,000. And what you're going to see over there if you add those two numbers together, they add up to $1,245,000. So my question is, where have you seen that number before? Well, that's very easy. We've seen that number before when we haven't taken out the loan, or as I like to say, bingo. If you don't take out the loan, whatever, you end up with $1.245 million. So the real question for my son is, how do I get that number back there? Well, I get that number back very simply. What I need my son to understand is that, son, if you go down to the Omaha Toyota dealership and buy yourself a $25,000 car, there's going to be different ways that they're going to want you to pay for that, right? You could lease it. You could finance it through them, or you could pay cash for it there. So if you were to finance it through them and you qualified for a 5% loan for $25,000, you'd have to pay $600 a month in order to pay that back, right? It's as simple as that. As everybody's looking at this slide right now, that's in the first red circle there, under loan repayment there. So what we're going to do is we're going to take that $25,000 loan. If we don't pay back the loan, whatever, it's the interest on that is 5%. 5% of 25,000 is 1,250. If you don't pay that loan in that year, the interest will accrue, so the total amount would be 26,250. That's under total loan. So what we're going to do, because life insurance companies can't actually show how to pay illustrations back immediately in the year that they take them, we're going to pay off this car in the next 4 years. So what we're going to do is you're going to have to pay back $600 a month, for the next 48 months, almost there. So that's $7,200 a year. So you're going to pay back $7,200, $72, $6,555. All right. So my question is, what did you pay in loan interest? So if you added those three numbers up, if you added up the 72, 72, 72, 655, they add up to 28,155 minus the original loan. So what did you pay in loan interest? You paid 3,155 over the course of those 5 years. Well, 5 years because you didn't start paying right away. That's one of the advantages of having a life insurance policy loan. You don't have to pay it back right away. You pay it back on your schedule. So let's take a look at this now. So the real question is, what did you actually pay to the life insurance company? What is your net cash outlay during that 5-year period, right? So if you take a look at the illustration that I have on the screen right now, in the other red circle, you'll see there's a minus 13,000. Well, how did that get there? Well, in year 6, the life insurance company gave you a $25,000 loan. You still paid your $12,000 premium. So from the life insurance company's perspective, it looks like you paid minus $13,000 to them, right? In year 7, you not only paid your $12,000 premium, you also paid $7,200 to start repaying that $25,000 loan. So that adds up to $19,200. You're going to do that in year 8, in year 9, in year 10. You know, the loan is finished through its amortization course there, whatever, and instead of paying $72,000, you paid $6,555 plus the $12,000 premium. That's $18,555, right? So what is your total net outlay? Well, if you think about it like this, your total net cash outlay is $63,155. What did you pay in premium during those 5 years? Well, you paid $12,000 a year for 5 years. That's $60,000. What's the difference? Well, that's the $3,155. And where have you seen that $3,155 before? Well, that's the total loan interest there. So from a net cash outlay point, the only thing extra you paid was the interest, because you've become the banker of your car by taking the money out of your own life insurance policy. You using your private reserve in order to do this. So if you take a $25,000 loan every 5 years for 35 years, and then repay the loan plus interest every 5 years, what do you end up with? Guess what? You end up with the $1,245,000 in your pocket, right? What's the cash value after paying back those loans? It's the $1.245 million. So, son, think about it. By paying back, repaying the $175,000 loan principal and approximately $22,085 in total loan interest, you get back in your pocket that $477,729. Instead of that going to the bank, instead of that being the opportunity cost, instead of it going to the dealership, you end up, if you become your own banker, if you become your own financier, you end up with the $1.2 million in your pocket. And then what are you going to do with that $1.245 million? Well, you're going to take your own tax-favored retirement income. So think about it. Here is a way for you, by making a decision right now at 30 years old, to put away money for yourself, because you're responsible for your own retirement. You're also responsible for your family. You're using that life insurance death benefit, which is constantly going to grow. It's going to grow from $540,000 to $2.08 million in 40 years. You're going to be able to finance every car you have during that time. And then once you're finished doing that, whatever, you're going to have the money in your pocket. It's not going to be in the banks. Because guess what? If you paid $28,000 every 5 years to the Toyota dealership, whose money is that? It's not in your pocket. By using your own life insurance policy to become your own banker, to create your own private reserve, to bank on yourself, you become the winner. And you're able to use your life insurance policy for the death benefit, as a deferred asset, and really importantly, as a current asset. And I think, other than seeing my name at the end of this, here's
which
my
is always
contact
wonderful, Marty.
So if you take a look at that, it should have my contact information there.
We have a couple questions, Marty. We have an agent who's asking, is the loan from my account or from the Carrier General Fund?
The beauty of this is that your life insurance, the loan from your life insurance policy is always from the life insurance carrier. So when you're paying back the loan and the loan principal and the loan interest, it's going back into, it's going to the company. The amazing phenomenon that happens, you're just using your policy as collateral. So your money continues to grow, even though it appears that you're using money from the policy.
Okay. Before we get to the additional questions, real quick, wanted to go over, we would love to get you contracted with Security Mutual. We are firm believer and friend of Security Mutual. This is a great concept, great product. They lead in the industry for private financing. I am launching a poll question. Please let us know if you'd like to get contracted with Security Mutual. We have a great paperless contracting system. We can do it in 4 pages, get that sent out to you. Anyone who's already set up on the paperless contracting system with us, we can go ahead and just get you signed up. All you need to do is just email me or give me a call and let me know. You know, we can get that completed for you. I'm going to give a few more seconds on that so we get as many people contracted as possible with Security Mutual, so we can get out some materials for you on the private financing and answer any of your additional questions. And on that, I'm going to go to the next poll question. So let's get that completed. Next poll question we have, let's take a look here. Sorry, we're having a snowstorm and our system's going in and out. I apologize. Is our Life and Annuity Academy. If you recall, the Life and Annuity Academy is our industry recognized academy. That is an all expense paid trip. We pay for it for 2 days, goes over all of the industry information, industry news, income riders, wealth transfer, of course, private financing, and single premium life. Would absolutely love to get you registered for that. That will be in February. We need your registration as early as possible. Again, we have between 300 and 400 people register. We take 40. So your early registration is imperative. I will leave that open for just a few more minutes as well. And then we can get to some of the questions. And I will go ahead and get that closed out. So another question that we have, let's see, the PowerPoint presentation is available. So anyone who's registered for this presentation or this webinar, you will get a copy of this link. So you will you will go ahead and get that. For commission levels, we will get everything sent out to you on that. So for what are the current interest rates and what are the loan rates, Marty, is one of the questions.
The current loan interest rate, it's a variable loan interest rate. It's 5%, and it's probably been 5% for the last 5-6 years. In terms of the dividend, I would say this about the dividend: Security Mutual is pretty competitive when it comes along those lines. But I think that when you're taking a look at different life insurance, whole life contracts, whatever, you really need to set them side by side and take a look at what the numbers actually are, because the two most important numbers, actually three most important numbers on the life insurance illustration are what happens if you're dead or what happens if you're going to surrender the contract. So the total death benefit is the first number you want to look at to compare. The second number is total cash surrender value. That's with the guarantees. That's with non-guarantees. And then, of course, what is your guaranteed surrender value? Security Mutual has 4 whole life products, and dividends are, dividend scale is the same, but the way that the policies are engineered are extremely fascinating. And you have to take a look at that when you compare them side by side. So in this last particular product that I use, the LP121, which is sort of our low-cost whole life product, it gives you the biggest bang for your dollar in terms of death benefit. But it also, normally when you take a look at most life insurance contracts on a guaranteed basis, it could take, 20, 25, 30 years for the guaranteed cash values to equal the cumulative premiums that you paid. In the LP121, normally it's by the 14th or 15th year, if you used an all-base contract, that your cash value would equal your total cumulative premiums paid on a guaranteed basis. It's unheard of. So the dividend column that you take a look at over there is going to be lower than, say, some of our other products. But hey, isn't it better to have all the money in your pocket or access to that money than waiting for it down the line? So
we have another question, Marty. When do you start taking out the $25,000, and how much do you have to have before you start taking out money for loans?
Well, the nice thing about Security Mutual is once we got involved with becoming your own banker and Circle of Wealth, we used to do like most companies and say that you couldn't get money out until after the first year. Now at Security Mutual, and we've been doing this for probably the last 7 years, is as soon as there's cash value appears in your contract, you're able to get it. So I like to say put in money day 1, you're able to take it out day 2, actually day 11 after the look. So, and okay, the amount that you're able to get out is normally 90% of the cash value.
So one of the questions is this utilizing a participating whole life or a universal? We are utilizing a whole life on that. Another agent states, I saw PUA on the illustration. Why use 121 product instead of one that endows in a shorter period, say 95, 99, or age 100? Isn't there more cash value available in the early years?
Well, you have your choice, and I'd happy to go over the different 4 products that we have. The real issue when it comes to what Security Mutual likes to think is that we offer you maximum premium and policy design flexibility. Because of our enhanced paid up edition rider, we're able to have an infinite number of permutations so that you can solve for any financing need and solve for it even within the first year. So what we always like to show is when would that product fully offset. If I were to show what the fully offset year would be for this particular illustration, it's going to be under 10 years. So theoretically, based on the guarantees and the current lowest dividend rate lowest dividend rate environment that we've been in years, whatever, no further premiums would be due down the line. So again, it's not so much of using a particular product type where you can stop paying premiums. You have that control by manipulating the policy design itself.
So we have another question here. Assuming the client already has a life policy, what would be the approach? At 1030, what would be the approach? And basically,
Well,
it's private financing, correct?
yeah, I mean, obviously, we love our whole life policies there. Could this be done with a UL policy or IUL? Yeah, of course it could. What I'd like to say is every policy becomes a banking policy. I could have set this up so that I paid 100% of the premium as base premium, meaning the cash values are going to grow are going to grow slower. The real issue is, how fast do I want that cash to appear in order for me to have access to it? And of course, considering, what kind of death benefit do I want along the way? So in effect, depending on your policy design, you can control however you want to set this up. And whether every life insurance policy ultimately becomes a banking policy. If you like the whole life guarantees and things associated with that, you certainly could do a 1035 exchange into a whole life policy from other ones and have instant access to that cash.
So what does the client receive at death? Is it the death? We have a question. The death benefit minus surrender value and loans. It has to be distributed as death benefit to be tax-free, correct?
Correct, yeah. On Security Mutual illustrations, the loans are taken into account, so the columns that you're looking at, when it says total death benefit, that's already calculating all the loans that have taken place there. So the number in the far right column, whenever you would look at it, is the number that you would receive.
Is the cash accumulation in the dividend account?
I'm sorry, say that one more time.
Is the cash accumulation in the dividend account?
No, I would say it the other way. I would say, the dividends are in the cash accumulation. Again, there's different ways to receive your dividends. The way that we've set these up is so that it buys more paid up additions. So the dividend option selected is to buy more paid up additions. So the interesting thing about this is, your base premium is going to receive dividends. Your paid up additions rider also receives dividends. So the idea would be is if I want to maximize the amount of dividends I want, well, I need to take I need to keep the paid up additions and the base premium, kind of intact there. So I would do that by taking loans. If I surrender my cost basis, well, I'm surrendering those paid up additions in order to do it. So that should in effect lower, what the dividend I would be receiving for that policy.
Is there a sweet spot age for this product, or basically the earlier the better, but is there a specific sweet spot age?
No. You could do this, again, it's all a matter of capitalization. If my son was 40 and, he saw the light at that point in time, whatever, in order to get to that 1.2 million, what would he have to do? Well, he'd just have to put in more money. He'd have to capitalize more. So the issue becomes how much money. If I think of my life insurance policy, or I think of becoming my own banker or banking on myself or creating my own private reserve, it's the matter of capitalization for me. The more money I'm going to put into this, the bigger it's going to grow, the faster it's going to grow. So if I wait, just like I wait for any investment, whatever, not to say life insurance is an investment, it's not. The longer I wait, that just requires me to put in additional monies. What if dividend rates went up? What if interest rates went up? Well, then I probably could put in less, but it really doesn't matter. When interest rates go up, that's when I want to start socking in as much money as possible, because it's going to grow even faster by doing that.
Can a person?
60-year-olds can do this. It's just a question of what do you feel is the best financial product? Where is the best place to park your money? Is your bank account the best place to park your money? We hear things in the news of banks wanting to charge people for people just having bank accounts in their own bank. I mean, that would be crazy, right? But if there's a possibility banks could start charging people for people putting money in the bank, just as the bank holding it there. Where is the best parking place for my money? Is it stocks, bonds, mutual funds, real estate? We like to say we think that the best parking place for your money is in a dividend-paying whole life insurance policy by a mutual carrier because of all the advantages that particular financial product offers.
So can a person 1035 another mutual policy from another company that has a loan already?
Yeah, I mean, companies say like Security Mutual, if the loan is less than if the loan is less than 50% of the total cash surrender value, we would accept that policy and also the loan that comes with it there. Anything, if it's above 50% of the cash surrender value, we wouldn't take it. And most companies don't do that. Mm-hmm. Ultimately, what you would want to do is you want to pay off that loan so that it's Nelson Nash always talks about stealing the peas. The whole thing about becoming your own banker is if you understand the relationship of who you are in this. If you become the bank, whatever, well, then you're also the depositor, you're also the loan department, and you're also you receive the dividends or the profits from the bank. So it always makes so much more sense when you take a policy loan to pay it back, because that just gives you incredible access to even more money. If I went back in these slides, I could show you, say like between, if I'm thinking about this right, in between years 15 and 20, the cash value was, I think in year 20, the cash value, between years 10 and 15. The cash value in year 10 was $128,000. If I take my loan and pay it back, what's my cash value in year 15? It's $228,000. So that means I had a net cash outlay of $63,000, but my cash value grew from $128,000 to $228,000. That's $100,000. That's $40,000 more than what I had. This is why we say, what is the best financial product? That's up for you to decide.
So we will be more than happy to answer any additional questions. So greatly appreciate everyone who attended on Cyber Monday. Really do appreciate it. Any questions that you may have, you can, of course, contact myself, Sandy Vacanti, 800-255-5055. Email address is Sandy, SANDY, at IAMSinc.com. Of course, Marty would be more than happy to answer any questions you have. You can see his number on the screen at 347-443-2178 and his email address of msmith@smlny.com. Marty, just such an amazing job. Thank you so much for your time and for Security Mutual putting together just a great webinar. So greatly appreciate it. And again, everyone who attended this webinar, thank you so much for your questions, for your attendance, and for your patience. It has not gone unnoticed by IAMS or Security Mutual, and we so greatly appreciate the opportunity. And with that, I will end the webinar, and again, so greatly appreciate everyone for attending.
Everyone, thank you, Sandy.
Oh, no problem. Thank you.